Hello friends, I am Ganesh Kamath. Welcome to Simply Speaking. You all must have heard this popular saying, as you sow, so shall you reap, which conveys a strong message to all the aspiring investors like you. It simply means you need to invest your money in a disciplined manner for achieving your financial goals in future. The world around us is changing faster than ever before. In this rapidly changing environment, it is crucial that we embrace ourselves to change and our conventional mindset towards investments. We must think beyond traditional investment products and look for better alternatives to achieve our financial goals. So, when the clock is ticking faster, we must accept, adapt, and advance. Each of us feel that our expenses are inching up higher than our income due to rising inflation and thus reducing our purchasing power. Today, inflation is at around 6.5% level. Let's assume you require rupees 40,000 now to meet your monthly expenses. Conservatively, even if we assume an inflation to grow at 4%, can you guess how much you will have to spend for the same monthly expenses 25 years from now? You will have to spend 1.07 lakhs. That's quite huge. Another startling fact, due to inflation, the worth of rupees 1,000 15 years from now will just be rupees 542. This way, you have a choice, either to let your wealth depreciate due to inflation or invest in the one that beats it. For instance, if you would have invested rupees 1,000 in equity 15 years ago, assuming a minimum return of 12% today, your wealth would have grown by more than 5 times. That's huge, right? While you have multiple investment avenues, including fixed income, gold, real estate, and so on, but your equity investments will substantially outpace inflation even after adjusting for it. When we plan to begin our investment journey into equities, we all get worried about 3 key factors. Any guesses? The 3 key factors are volatility, volatility, and volatility. In fact, we should consider this as an inherent feature of the asset class than a risk to our wealth creation. For instance, here let me give you an example of Nifty 50, which is the benchmark index that tracks the performance of the portfolio of large cap companies. Nifty 50 has experienced multiple falls from the previous highs in the last 20 years. However, if an investor would have stayed invested patiently during this time, he would have multiplied his wealth by 25 times. Thus, you might experience your equity investment journey to be a bumpy ride, but the destination makes it worth. As rightly said by an American author, Simon Sinek, dream big, start small, but most of all, start. In this context, when we think of starting smaller into equities, we generally come across the most powerful 3-letter word, Systematic Investment Plan, widely known as SIP. SIP into mutual funds allows you to invest into equity markets in a staggered manner without timing the market. During market movements, SIP investments will provide you comfort against volatility. When the markets rise, you tend to experience higher valuation in your existing SIP investments, whereas you shall buy more units when the markets fall. This way, your SIP will average the cost of your units purchased in the long run and help you remain invested. SIP is the most affordable and convenient mechanism that has gained immense popularity amongst investors over the years for its ability to be a simple yet an effective method of creating long-term wealth.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.